With historic elections about to take place, ones which could dramatically affect the mainstream and crypto markets, charts are floating around claiming how bullish these elections typically are for markets. While we're all praying for a hasty resolution of this crazy financial circus and macro bear market that has completely crushed risk assets, the question remains, will a bullish midterm election narrative actually play out and save the markets? Or will different factors like liquidity and the Fed policies end up taking precedent and continuing to smother our beloved risk assets in the stock market as well as cryptocurrency? Now, if you'd like these midterms to send our crypto to the moon, all you need to do is smash that like button. It takes about 2 seconds and it shows YouTube as well as me that you enjoyed the content, and I appreciate it. As always, if you're enjoying these videos helping you get ahead and stay ahead of these crazy times, combining macro news, micro news, Web3 news, NFT, crypto, Bitcoin, and even strategies to improve yourself and make money online, then make sure you subscribe and put that bell notification on, because we're going to be bringing you content each and every week, no matter how crazy this market gets. That said, let's jump in. So let's get this out of the way. There's absolutely no doubt that historical backtests show that the midterms is typically a bullish period for the markets. No matter which way you slice it, the charts reveal that there is a post-election bump. Even in the case of a second-year new Democratic president, which is the lowest of all the effects, we still see positive effects generally after the midterms. We also see folks like Morgan Stanley predicting even more rallying in the equities markets. However, we have to keep something very clear. Most of this data that we're looking at comes during bull markets, and that's because most of the time it's a bull market. There's only been a select few recessions and bear markets in the history of the US stock market, and literally zero in the history of cryptocurrency. So we have to take everything we see with this data with a grain of salt. And in fact, it might make more sense to compare it to data from those bearish periods. As we can see in bear markets, conditional seasonality shows that the effect of the midterm elections is sometimes way less potent during bear markets. That's the red line. And Credit Suisse, not that their name is the hottest in the streets right now, they take it one step further and say, although historical equity market returns following midterms have very frequently been positive, we believe any link is coincidental, not causal. And one of the things we absolutely must account for right now is the hyper-politicization of our modern world. The markets are just a tool to whipsaw the elections. So really what we would think about is what would happen if we get a lame duck Congress, or effectively the red sweep, and the Republicans end up in control of Congress. Of course, the effect of that would actually be the Republicans likely making it very difficult on the presidency. Remember, we're almost always campaigning against the current president. Usually the average voter doesn't assign blame for whatever happens to Congress. They're thinking, okay, whoever's in the presidency, well, it's their fault, whatever's happening. So if Republicans get control of the House, it would behoove them to make the economy effectively perform as bad as possible while Joe Biden is a sitting president. It's just gamesmanship. One of the things we have to take into account is that if the Republicans gain control of Congress, they'll probably try to make things as bad as possible on Mr. Joe Biden. And of course, we got a slightly confusing tweet from Elon, who's claiming that he wants Twitter to be politically neutral, but then pretty much just comes out and says, yeah, if you're an independent, you should vote for the Republicans. But there is a point here, as Carlo Cassio points out, Elon has a point from the standpoint of markets in that gridlock is historically bullish. The reason why gridlock is bullish is because you actually have less unknowns. What you do know is that almost nothing will happen in a gridlocked environment, meaning that Congress and the presidency are split. In that environment, less gets through, less changes happen. And remember, markets hate change. They hate the unknown. The more is known, the less variables changing, the more the market usually goes into a bullish posturing. It just makes sense. Investors don't like uncertainty. And let's take this even one step further. One of the things that could really extend these bear market rallies and delay the effects of what we're seeing across the effects of inflation, as well as the potential recession, is if the presidency is able to continue spending money. Of course, he'll have to go to Congress for that, and if the Republicans are in charge, you better believe they'll be beating the drum of fiscal conservatism. So what does that mean? It means that if the Republicans win, well, Joe Biden will be able to spend less money, and whatever negative effects from the economy are coming will most likely come faster. Now, that actually plays into the hand of the Fed, who are desperate really to see the economy go into down-only mode, and then that way they can say inflation is back under control. Because, well, there's no demand. Again, a recession is a dark time, but at this point, it feels like like that's what the Fed is driving us towards as a way to combat inflation. The next interesting narrative here is about the potential topping out of the US dollar and a decline in DXY. Now, in normal recessions, the dollar goes down as well as stocks, but usually things like gold will outperform. So once we exit this first phase of the inflationary bear market, where stocks and bonds and gold and Bitcoin and everything were going down in tandem, we can actually see a world where there might be upside in certain asset categories. This would begin a new phase of the bear market. Now, personally for me, I'd like to see some confirmation that the data the Fed is using to actually dictate their increasingly hostile measures against markets, we'd like to see some of that actually working. Lower inflation numbers, a weakening jobs market, and in general, the Fed being able to say, hey, we've done our job. And for that reason, I remain very weary of any short-term bull thesis. As you know, on this channel, I've been waiting, and patience to me is the ultimate difficult thing to have, both on the way up and the way down. Now, in the particular case, I'd like to add this one detail. According to Paolo Macro here, who's had some amazing posts this bear market, he says, step back. Most hedge funds are down a lot, still own the wrong stuff. On leverage, net long into rising volatility regime where everyone is hedging daily for an upside crash. That's your picture. Everyone else, retail, passive, high net worth individuals, private banking, pensions, has only begun to sell. Remember when we told you that retail really needs to capitulate in order for this thing to end? Well, that's kind of the point being made here, is that we haven't seen capitulation. And if you think that the biggest money bags, the richest entities in the world, the pro trading firms, the big shadow banks, the Illuminati, do you think that they want retail to be the ones getting the ultimate best price and buying the dip, getting rich off the next cycle before they really crush things and get their low price? I don't think it's tinfoil hat stuff at this point to realize that these big entities are not trading on your behalf. They don't want you to win. So from a data-driven as well as a non-data-driven approach, you can imagine that retailers having some more panic before this whole thing ends is definitely something that I see on my bingo card. So let's take just 1 minute and discuss the bullishness in the market over the last few weeks, because we all know the markets have done pretty well since about the beginning of October. Some will point to the midterms, some will point to seasonality, some will even claim this is the beginning of the Santa Claus rally. But I like a little bit more hard data, and remember how I've been obsessed with macro data as the real driver of everything happening in markets now that I'm zooming out much further, but definitely since November, where they pivoted and started crushing our bags. Well, let's check out this tweet by Max Anderson, who is a disciple of Darius Dale. Big shout out to Darius Dale and Max here, who's been doing amazing work. Check it out. The US Treasury pumped $165 billion into the economy since the start of October, just as we head into midterms. This fully canceled out the stated $90 billion per month of quantitative tightening. So instead of negative $90 billion, they went positive $165 billion. By nearly a factor of 2x, they canceled out their stated quantitative tightening. So when you add more money to the markets, yes, you get higher asset prices. But the real question is what happens next? Well, Max is here with another update. He comes in here just minutes ago to say a brief reminder that the US Treasury will join forces with the Fed in waging a war on your portfolio. Stated plans call for a combined $350 billion of net liquidity removal over the next 8 weeks. This means after the elections end, we have the real effects of quantitative tightening, which haven't been real or authentic so far. And this is, of course, we can guess because of the elections. We all knew the elections would come in to a certain degree, but instead of pumping our bags, really they might have just kept us from going into a true spiral in the asset markets that might be ahead of us. Again, I can't predict the future, but I like to find detailed and relevant data to explain the past. And this isn't the only thing happening this week. We have the election on Tuesday, we have CPI inflation data on Thursday, and consumer sentiment on Friday, all very important metrics to understand where the economy is as a whole. All this talk about a pivot, about a change, without really seeing the effects on inflation, which is the big bad boogeyman that we're fighting here. If inflation spirals out of control, the economy will be in deep trouble. People won't be able to afford food or gas. Businesses won't be able to operate. The whole system gets thrown into disarray. So having stability of prices is utterly critical. And if the Fed pivots too fast, well, guess what? They'll have to unpivot. As Paper Alpha Trader says here, do not discount the very real possibility of a need for another rate hiking cycles. All journeys need breaks. Echoing this, Paulo Macro says, and in the meantime, if Fed loses spine and softens the approach, energy and associated costs will scream higher, unhinging margins and economic growth and stability in the process, thereby worsening the ultimate economic outcome and lowering the ultimate market bottom. We're still stuck in the good news is bad news cycle. Until inflation comes down, good news is not good news. We need need to control costs. And in order to do that, we need inflation to come down. And this can't just be 1 month's worth of printing. We need to see a long-term trend of inflation returning back to sustainable levels. As familiar face on the channel, Wifey Alpha has stated, this is set up to be one of the biggest bear markets of our generation. The biggest danger is in rushing to conclusions and jumping in too far ahead of the curve. If there are 4 stages to this, we're in stage 2. And stage 2 is known to have incredible bear market rallies. Eventually, stage 3 is panic, and stage 4 is deflation, where once again prices begin to decline versus the dollar. Once that happens and the dollar becomes stronger, once again the Fed can go back to their playbook of printing money and making the economy do what it does best, which is have assets grow in value. Effectively, how the rich get richer. That is absolutely the system in play. The main thing is to not blow up and to not lose all your money until we actually really see how long this cycle is going to be. In the meantime, there can be really long extended rallies, but just know until we really defeat that boogeyman of inflation, it's hard for me to see a permanent sustaining rally, meaning the beginning of a new bull market. Now, I do want to remind you, from Monday through Thursday at 9 a.m. Pacific, I'm doing daily live streams, Twitter Spaces on Twitter with some amazing co-hosts. It's called the Web3 Show with me, EllioTrades. It's been one of the most fun experiences I've had, and a totally different type of content where you can hear an open format back and forth. Definitely check it out. I've linked Monday's episode in the description, and I hope it helps you gaining even a deeper understanding of where I'm at with the markets. And I hope you tune in daily, as we're going to have some absolutely amazing content, and it's just a new way to interact with me and the content. I can share more thoughts in a more open format than I can here on YouTube. No matter what the outcome, you can participate in gaining some knowledge here on this channel. If you enjoy the content, make sure you hit that like button and subscribe. As always, you can follow me for other content on Twitter at EllioTrades. For everyone out there fighting the good fight during the bear market, remember, patience is a superpower, and we'll be here with you the entire way through the journey. Curious what you think about today's episode and my analysis overall as we head deeper and deeper into this bear market. I'm pushing myself to kick the content up each and every week here. Let me know how I'm doing in the comments, and I'll see you very soon on the next episode.